Almost everybody wants to build wealth. You hear it everywhere, in the barbershop, at the cookout, on your timeline. I need to start investing. I need to get my money right. I need multiple streams of income. Everybody's talking about it, and everybody means it. But here's what actually happens the moment someone tries to get started. They open up the stock market app. They Google how to invest. They watch one YouTube video, and immediately they get hit with a tidal wave of words they've never heard in their life. GameStop, AMC, Tesla, crypto, options, calls, puts, futures, dividends. And just like that, the brain shuts off. You close the app, you tell yourself you'll figure it out later. Later never comes, and another month goes by with your money sitting in a checking account doing absolutely nothing, while inflation quietly eats away at it every single day. Sound familiar? I see you, and I've been there. But today, that changes. Today, I'm putting you on to one of the most powerful, beginner-friendly investing tools ever created. No picking stocks, no complicated charts, no finance degree required. Just knowledge, consistency, and a willingness to start. Let's go. Let me be real with you about something first. The problem isn't that people don't want to invest. Everybody wants to grow their money. That's basic. That's literally survival instinct. The real problem is that the internet turned investing into an absolute circus. And I mean that. It is chaotic out there. You open YouTube and one guy is telling you to put everything in crypto. You scroll TikTok and somebody's hyping up a penny stock saying it's about to moon. You check Reddit and it's just pure chaos. Diamond hands, apes together strong, YOLO trades. And somewhere in the middle of all that noise, you're just a regular person trying to figure out if you can turn $200 into something real. Something that could actually make a difference in your life. Here's the cold truth most of those gurus won't tell you. They do not care about your money. They care about their money, the views, the followers, the sponsorships, the affiliate links. Every time you click on their video, whether their advice works or not, they get paid. Your wins and losses don't affect their bank account at all. Which means, and hear me on this, nobody cares about your money more than you do. Which means you have to understand the game yourself. You can't outsource your financial future to somebody chasing clout. And that doesn't mean you need to become a finance expert overnight. It means you need to understand the basics well enough to make smart decisions. And today, we're building that foundation together. But first, let me show you exactly how the misinformation trap works. Because understanding the problem is the first step to solving it. When you're new to investing, you're vulnerable. You don't know what you don't know. And the internet is full of people who exploit exactly that. They use flashy thumbnails, Lambo photos, screenshots of big gains. And they make it look like investing is either incredibly easy, just follow my picks, or incredibly complicated. You need my $500 course to understand it. Neither of those is true. The truth lives somewhere in the middle. Investing is not magic. It's not a lottery ticket, but it's also not rocket science. It is a learnable skill. And the people who benefit most are the ones who start early, stay consistent, and don't get distracted by the noise. So let's cut through the noise right now. Alright, here's where it gets good. I want to introduce you to something called an ETF. ETF stands for Exchange Traded Fund. Now I know that sounds like a mouthful, but stay with me. Because once I explain what this actually is, you're going to wonder why you've never heard it talked about in simple terms before. Here's the basic concept. When most people think about investing, they think about buying stock in one specific company, like buying Apple stock, or Nike stock, or Amazon stock. That's how a lot of people start. And it feels exciting. You're a part owner of a real company. But here's the issue. What if that one company has a bad year? What if their CEO says something dumb? What if they get hit with a lawsuit? What if a competitor wipes them out? Suddenly, your investment is down 40% and there's nothing you can do about it. That's the risk of putting all your money into one company. And that risk is real. Even the biggest, most successful companies go through rough patches. Even Apple, even Amazon, even Google. So what if there was a way to own a little piece of all of them? What if you could buy one thing and instantly have exposure to hundreds of companies at once? That's exactly what an ETF does. Instead of buying stock in one company, you buy a whole basket of companies all at once. One purchase, one price, hundreds of companies. Think about what that means. If one company in your ETF has a terrible year, the other 499 companies can carry the weight. Your whole portfolio doesn't crash just because one company stumbles. That is called diversification, and it is one of the most important concepts in all of investing. Spreading your money across many different investments so no single one can knock you out. Wall Street has known about this for decades. The wealthy have been using it to protect and grow their money for generations, and now it is fully available to everyone, including you. You can buy an ETF through any major investing app. Fidelity, Schwab, SoFi, Robinhood, Webull, they all offer them. And in some cases, you can get started for less than the price of a meal. The barrier to entry has never been lower. The question is no longer, can I invest? The question is, why haven't I started yet? And most of the time, the honest answer is nobody ever broke it down in a way that made sense. Until now. So let's keep going. All right, let me give you an analogy that's going to make this click forever. I want you to come with me to the grocery store, not to buy food. Well, kind of. Just stay with me. Picture yourself walking into your go-to grocery store. You're hungry. You want snacks. So you head to the chip aisle. And this chip aisle is stocked. Potato chips, pretzels, popcorn, crackers, pork rinds, tortilla chips, veggie straws, every brand, every flavor, every size. Now you gotta pick one. Which one you going with? Maybe you gotta go to. Maybe you're feeling adventurous today. But here's the thing. You don't actually know which one is gonna be the best this week. Maybe Doritos are having a moment. Maybe a new flavor just dropped and it's flying off the shelves. Maybe Takis are about to get recalled for some reason. Who knows? You can guess, you can research, you can ask the store employee, but at the end of the day, picking one chip brand is a gamble. What if that brand has a bad quarter? What if their prices go up? What if a competitor eats their lunch? But now, imagine something different. What if, instead of picking just one chip brand, you could buy the entire chip aisle? Every brand, every flavor, every bag. Now it doesn't matter which specific chip pops off, because you own a piece of all of them. One brand has a great year, you win. Two brands have a great year, you win more. One brand totally flops, no problem, because the other 20 brands carry it. You're protected, you're diversified, you're covered. That is exactly what an ETF does for your investments. Instead of picking one company and praying it goes up, you invest in an entire industry, sector, or market all at once. The whole chip aisle, all of it, yours. Now imagine that chip aisle isn't snacks. Imagine it's technology companies or healthcare companies or the entire US stock market. You own a tiny piece of hundreds or even thousands of companies, all from one purchase. That's the power of the ETF. And honestly, it's why ETFs are the #1 recommendation for beginner investors by some of the greatest financial minds in history, including Warren Buffett, one of the greatest investors to ever live. Warren Buffett has publicly said multiple times that for most regular people, investing in a low-cost index ETF and holding it long-term beats almost every other strategy. Not picking stocks, not timing the market, not following the hot tips. Just buy the basket, hold the basket, let it grow. Simple, unglamorous, but incredibly effective over time. The grocery store analogy works because it removes all the complexity. At the end of the day, you're just buying the whole aisle. Okay, now that we understand what an ETF is, let's talk about why this approach works so well for people just getting started. All right, let's get into exactly why ETFs are such a game changer for beginners specifically. Because there are a few reasons that go beyond just it's less risky. And understanding these reasons is what makes the strategy click. The first reason is what we already talked about, diversification. When you buy an ETF, you are instantly protected from the failure of any single company. Your money is spread across so many different companies that no single bad event can wipe you out. Think about what that means psychologically too. You don't have to obsess over every piece of news about every company. You're not checking your phone every 5 minutes to see if your one stock went up or down. That kind of mental peace, it's underrated. Stress about money is one of the biggest causes of bad financial decisions. When you're not stressed, you make better choices. The second reason ETFs are powerful is the time factor. Picking individual stocks the right way takes a lot of research. We're talking reading annual reports, analyzing earnings, understanding entire industries. That is literally a full-time job. Professional stock analysts, people with finance degrees and decades of experience, do this 40 to 60 hours a week, and a lot of them still underperform the market. Let that sink in. People who dedicate their entire careers to picking stocks, many of them don't beat a simple ETF. So why would a beginner try to do the same thing on their lunch break? ETFs take all of that pressure off. You don't need to research individual companies. The ETF does the heavy lifting for you. The third reason, and this one is big, is cost. ETFs are generally very inexpensive to own. We're talking fees as low as 0.03% per year. That means if you have $1,000 invested in a certain ETF, you might pay just 30 cents in fees for the entire year. 30 cents, that's less than a gumball. Compare that to actively managed mutual funds that charge 1%, 2%, sometimes even more. Over 20 or 30 years, that fee difference compounds into thousands, sometimes tens of thousands of dollars. ETFs keep more of your money working for you instead of going into someone else's pocket. So to recap why ETFs work so well for beginners: instant diversification, low research required, low cost, proven track record. It's about as close to a no-brainer starting point as investing gets. Okay, so now you know what an ETF is and why it works. But here's something a lot of beginner videos skip over. Not all ETFs are the same. There are different types of ETFs, and each one does something slightly different. Let me walk you through the main ones so you know what you're looking at when you start researching. First, index ETFs. An index ETF tracks a market index. The most famous example is the S&P 500, which is basically a list of the 500 largest publicly traded companies in the United States. When you buy an S&P 500 ETF, you own a tiny piece of all 500 of those companies: Apple, Microsoft, Google, Amazon, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, you name it. If it's in the S&P 500, you own a piece of it. And historically, the S&P 500 has averaged roughly 10% annual returns over the long run. That means money doubles approximately every 7 years at that rate. Not every year, there are good years and bad years, but over the long run, the market has always recovered and gone higher. Second, sector ETFs. Instead of tracking the whole market, sector ETFs focus on one specific industry, like a tech ETF that only holds technology companies, or a healthcare ETF that only holds hospitals, pharma, and biotech. If you believe a specific industry is about to grow, sector ETFs let you make a targeted bet without picking individual stocks within that industry. You like what's happening in clean energy? There's an ETF for that. Bullish on AI and technology? There's an ETF for that too. Third, dividend ETFs. These are ETFs specifically designed to hold companies that pay regular dividends. Dividends are payments companies make to their shareholders, usually every 3 months. You literally get paid just for holding the ETF. It's passive income in the most literal sense. Your money is invested, the companies make profits, they share those profits with you, you don't have to do anything. Some dividend ETFs pay monthly, some quarterly, and as your investment grows, those payments grow too. A lot of serious investors reinvest their dividends to compound their gains even faster. Fourth, bond ETFs. I'll keep this one brief because it's less exciting but worth knowing about. Bond ETFs hold government or corporate bonds instead of stocks. They're generally lower risk and lower reward. They're often used by older investors or people who want stability over growth. As a young person starting out, you likely want more growth, so bond ETFs probably aren't your first stop, but it's good to know they exist. The point is, the ETF world is vast and gives you options for whatever investing goal you have. Just starting out, index ETF. Want passive income? Dividend ETF. Interested in a specific industry? Sector ETF. Want to be conservative? Bond ETF. There's something for every goal. Okay, so now you know what ETFs are and the different types. But before you go open an app and just start buying, I need to walk you through 3 critical things to check on any ETF before you put money in. These are non-negotiable. Write these down. Number 1, the expense ratio. Every ETF charges a small annual fee for managing the fund. That's called the expense ratio. It automatically comes out of your returns. You don't get a separate bill, but it absolutely affects how much you make. Think of it like a service charge at a restaurant. A low expense ratio, 0.03% to 0.20%. Good, very reasonable. A high expense ratio, 1% or more, should make you ask why. The lower the expense ratio, the more of your money stays invested and working for you. This might sound like a tiny difference, but over 20 or 30 years of investing, a 1% fee difference can literally cost you tens of thousands of dollars. This matters more than most people realize. Number 2, the dividend yield. The dividend yield tells you how much the ETF pays you annually just for holding it. It's expressed as a percentage of your investment. So if an ETF has a 2% dividend yield and you have $1,000 invested, you'd earn $20 that year just from dividends. Not all ETFs pay dividends. Some reinvest profits back into the fund instead. Neither is automatically better. It depends on your goal. Want regular cash payments? Look for dividend yield. Want everything reinvested for max growth? Growth ETFs work differently, but as a beginner, knowing that dividends exist and how to find them is a key skill. It changes how you think about investing when you realize your portfolio can literally generate income. Number 3, what's actually inside the ETF? This one is the most important and the most skipped by beginners. You need to know what companies are actually in the ETF before you buy it. Don't just look at the name and assume. Look at the holdings. Every ETF has a list of its holdings publicly available. The top 10 holdings are usually shown for free on any platform, and a lot of times the top few holdings make up a big chunk of the entire fund. So if you buy a tech ETF, make sure you actually believe in the tech industry. If you buy an energy ETF, make sure you understand what you're investing in. Never put money into something you don't understand. That rule never expires. You don't need to understand every company inside the ETF, but you should understand the overall theme, the sector, the index, the strategy. Know what you own, always. Okay, and now we get to the question I know has been sitting in the back of your mind this whole video. How much money do I actually need to start investing? And I want to give you the most honest answer I can. The answer is start with whatever you have. I'm not being cliche, I'm being literal. Some platforms allow you to start with $1 using fractional shares. Fractional shares mean you don't have to buy an entire share of an ETF. If an ETF costs $400 per share, you can buy a quarter of a share for $100, or a tenth for $40. Your ownership is proportional to what you invest. Platforms like Fidelity and Schwab let you buy fractional shares with no minimums. Others, like Robinhood and SoFi, have similar features. The accessibility is real. The barriers are lower than they've ever been. Now I know what some of you might be thinking. What is $20 or $50 really going to do for me? And I get it. That feels small. It might even feel silly. But here's how I want you to reframe this. You're not investing $50 to get rich off $50. You're investing $50 to learn how the game works, to get comfortable with the app, to experience a market dip and feel what it's like to not panic, to receive your first dividend, even if it's only 47 cents, to build the habit of investing before the amounts are life-changing. Because here's the truth. The person who starts investing $50 a month at 22 years old will almost always end up wealthier than the person who waits until 35 to start with $500 a month. Time in the market beats timing the market every time. Compound interest, which is when your returns generate their own returns, is the most powerful force in investing, and it only works if you give it time. Starting early with less is almost always better than starting late with more. So don't let "I don't have enough money" be the reason you never start. Start with $10. Start with $25. Start with whatever you have right now. Then increase it as your income grows. The goal in year one is not to make a lot of money. The goal is to build the habit, learn the system, and stay consistent. The money will follow. Before we get to the final piece of this video, I need to talk about mistakes. Because a lot of beginners learn what to do and then still mess up because of avoidable errors. Let me save you some pain. Mistake 1. Investing based on hype. You see a stock or ETF blowing up on social media. Everybody's talking about it. It's up 200% this month. And the temptation is to jump in before it goes even higher. This is called FOMO, fear of missing out, and it is one of the most dangerous emotions in investing. By the time something is trending on social media, you've usually already missed the best entry point. Smart investing is boring, on purpose. You are not trying to catch the wave at the top. You're building something slow and steady. Mistake 2, panic selling. The market goes down, sometimes a lot. In 2008, the market dropped nearly 50%. In March 2020, it crashed 34% in about 30 days. And when that happens, the instinct is to sell before it gets worse. That instinct is almost always wrong. Every single major market crash in history has been followed by a recovery. Every one. No exceptions. The people who sold at the bottom locked in their losses forever. The people who held, or even bought more, made their money back and then some. Market dips are not emergencies. For long-term investors, they can actually be opportunities. Mistake 3, trying to time the market. I'm going to wait until the market drops to buy. I'm going to wait until things are more stable. I'm going to buy when it hits a certain price. This sounds smart. It feels strategic. But here's the problem. Nobody, and I mean nobody, can consistently time the market. Not hedge fund managers, not Wall Street veterans, not algorithms. The strategy that actually works is called dollar cost averaging. You invest a fixed amount consistently, every week, every 2 weeks, every month, no matter what the market is doing. When prices are high, your money buys fewer shares. When prices are low, it buys more. Over time, this averages out to a solid entry price. And you never have to worry about picking the perfect moment because you're always in the game. All right, I want to zoom out for a second and talk about something bigger because this video isn't really about ETFs. ETFs are just the vehicle. The destination is something more important. For a long time in this country, investing was treated like it belonged to a specific type of person. You needed the right connections, the right school, the right last name. Wall Street felt like a members-only club, and that wasn't an accident. Financial literacy was never taught in most schools. The people who grew up knowing about investing usually learned it at home, from parents who already had money. If nobody in your family ever talked about stocks, ETFs, compound interest, it's not because it wasn't available, it's because nobody taught you, and that gap was passed down from generation to generation. That cycle ends with information. And that's why this video matters. Not just because you'll learn what an ETF is, but because you'll be the person who teaches the next generation. The moment you start investing, you change your family tree. Your kids will grow up in a household where investing is normal. That's generational wealth. That's the actual goal. And look, I'm not promising it's easy or that it happens overnight. Building wealth is a long game. It requires patience, consistency, and the ability to ignore the noise. But you have every tool you need, right now, today. You have access to the same tools that wealthy people have been using for decades. The only difference is, now you know about them. That knowledge is the most valuable thing in this video, because the rich didn't get rich by finding secret investments nobody else knew about. They got rich by starting early, staying consistent, and letting time and compound interest do the heavy lifting. Those things are available to everyone, including you, including your family, including your whole community. Today, Wall Street looks like all of us. Young people, first-generation investors, people from every zip code, building portfolios, creating wealth, changing the game. All right, let's bring it all home. What is an ETF? An exchange traded fund is one investment that holds many companies at once. Instead of picking one stock, you buy the whole basket. Why does it work? Instant diversification, low cost, low research required, Proven long-term track record. Beginner-friendly from day one. Before you buy, check the expense ratio. Lower is better. Check the dividend yield. Free money just for holding. Check the holdings. Know what you own. How much to start? Whatever you have. $10, $25, $50. The habit matters more than the amount. Start now, increase later. Mistakes to avoid. Don't invest based on hype. Don't panic sell during dips. Don't try to time the market. Stay consistent with dollar cost averaging. The game is real. The tools are available. The information is in your hands. There is nothing standing between you and starting your investing journey today. Nothing except the decision to begin. The best time to plant a tree was 20 years ago. The second best time is right now. So when this video ends, don't just watch the next video. Don't just like and subscribe and forget. Open an app, search an ETF, put in whatever you have. Because the moment you start investing, your money stops just sitting there. It starts working for you, while you sleep, while you live your life, while you keep grinding. Your money finally has a job, and that job is to help you build something bigger than where you started. That's what financial freedom actually looks like in the early stages. It's not a Lambo tomorrow. It's a better life, built deliberately, one decision at a time, and it starts today. Go make moves.